All right, thank you everybody for joining us. My name is Zahir Issa. I'm a relationship manager with Bank of Montreal, and I'm also an executive committee member of Young Canadian Finance's Ottawa chapter. We're very excited to be hosting our first event of 2022 with BMO's Chief Risk Officer, Patrick Cronin. Pat is BMO's Chief Risk Officer. He was appointed in November of 2018. Prior to this, he was the CEO and group head of BMO Capital Markets, as well as the president and chief operating officer of BMO Capital Markets as well. He joined the bank in 1993 and has held a variety of leadership positions. Pat is also an active member of BMO's Enterprise Risk Management Committee. Today, we're going to be hosting a fireside, or should I say virtual fireside chat, to discuss a number of topics, including post-COVID economic outlook, inflation and housing discussion, Russia and Ukraine, as well as lead into a Q&A session at the end there. So I just want to kick things off. Pat, thank you so much for joining us. We're really excited to have you.
Well, thanks for having me. It's my pleasure to be here, and really looking forward to a fun conversation.
Perfect. So let's just jump into things then. Let's first talk about the COVID-19 pandemic. It's been a long 2 years, and we're finally starting to see some sense of normalcy. Recently here in Ontario, the mask mandate was just lifted just this Monday. Capacity restrictions have eased. We're starting to kind of transition to a normalcy, which I think everybody is looking forward to, not only in Ontario, but across Canada. And I just want to get your sort of high level thoughts now on how you see things from a macro and also micro economic level with the full reopening here, not only in Ontario, but across across Canada.
Sure. Well, thanks for the question. I guess maybe before I answer, I wouldn't work for a bank if I didn't give a legal disclaimer before I talked. So I'll just remind folks that my answers today and remarks today are just me as Pat Cronin. I'm not speaking for the Bank of Montreal. We have a whole lot of really, really smart people at the bank that handle things like economic outlooks and things like that. So for the official view of the bank, I would refer you to them, but I'm happy to answer questions from my own perspective today. In terms of reopening, I guess I see a couple of things. There's kind of some push and pull happening at the same time here, as I'm sure your group knows well. But I think one of the biggest impacts coming out of this is going to be inflation, frankly, and that's I'm sure not a surprise to anybody. And I think those inflationary pressures are going to persist, notwithstanding policymaker action, mostly because there's just frankly been too much stimulus over the course of the past 2 years. I think when we look at the amount of cash that is still sitting on consumer balance sheets and corporate balance sheets as well, it feels like a lot of price increase can be passed through to consumers, and they can handle it, at least in the short term, with excess cash capacity. So I think inflation is going to be here with us for a while. So I guess that's number one. Part and parcel with that, of course, will be rising rates. And this is, to me, probably the bigger issue. Inflation has lots of connotations to it, but the rising rate element of it, I think, is quite a game changer, actually, in the trajectory of the economy. If you think about it, we've been in kind of a 14-year period here since coming out of the financial crisis in 2008 of really ultra low rates. They don't seem ultra low to us after we've been living with it in this environment for a while, but relative to most periods in history, this has been a period of excessively low interest rates. And to me, what I've seen is that's completely reshaped the risk return spectrum that you would find in the marketplace. And you see that in risk premia broadly across the spectrum. But if you look at just simple things like where high yield is priced today, that's where investment grade was priced 15 years ago. You only have to look at the rise of private equity, CLOs, venture capital, structured products, obviously driven by several factors. But I think the most important is low rates and that search for yield that we've seen from really all investor constituents. So coupled on top of that, we've also got ultra accommodative monetary policy for 14 years. And particularly with quantitative easing, and that's created an enormous amount of capital and really, really excessive liquidity positions that are also at play at the same time as you've got these low rate conditions. And so what's happened is we've seen this massive buildup of leverage in the system. And you can look at almost any metric of leverage, consumer or corporate, and you can see we're in uncharted territory. And I think the risks of leverage and the lessons of excess leverage have largely been forgotten because we've gone through this period. And, during this period, defaults on corporate debt or sovereign debt have been extremely low. And maybe more importantly, the carrying cost of debt, frankly, is quite easy. So all of that, low rates, excess liquidity, quantitative easing, changing perceptions about leverage have really remade the risk playing field. And all of that is now about to change. And my view personally is that in all of that activity, a lot of distortions have been created. And I touched on some of them, but maybe housing, we'll talk about that later. That's another one. But a lot of distortions have been created through these abnormal conditions that have persisted for 14 years that are about to reverse. And maybe the last problem of many is that we've got an entire generation of risk managers who have never lived through a period of high rates, wage inflation, high corporate debt default, sovereign defaults. And so we're getting into a very challenging period with a constituent of risk managers broadly, not just in risk groups like mine, but broadly, who don't have maybe the same level of experience. So I think that's a trend that's really going to shape the economy for the next 10 years probably.
Yeah, it's very interesting that you touch about going back to the financial crisis. I think a lot of people have just been focusing on these past 2 years since the pandemic sort of started and the impacts there. But there's a lot of good points that you're raising since back from the financial crisis. You talked about stimulus, which obviously was a big topic of conversation. And I think where a lot of people had some sort of concerns or some doubt was sort of this cycle of where we were going in and out of shutdowns and in and out of restrictions and things like that. Again, speaking to that uncertainty. With the way things are going now, I mean, what are your thoughts in terms of the potential for another type of shutdown or restrictions and how that's going to impact policymakers when it comes to things like stimulus?
Yeah, I think it's not going to impact much at all. And that might sound a little counterintuitive because I think everybody knows case numbers are rising again, unfortunately. But a couple of reasons. First, I think at least based on the data that we track, hospitalizations aren't rising at rates that would cause health officials, at least at this point, to suggest restrictions. And I'm basing that on level of hospitalizations in prior periods that caused health officials to suggest restrictions. We're not back to those levels yet, even though case numbers are rising. Secondly, probably more practically, public attitudes towards restrictions have shifted dramatically. So here, I think you're in Ottawa, so you probably know better than anybody what that looks like. And so I don't think that there's a lot of political will there for another round of restrictions in the face of that. I think the other thing though we found too, particularly in Canada and the United States, is that the companies, obviously there was stimulus and that certainly helped the consumer, but on the corporate side of things, companies had a significantly greater capability than we expected to manage through COVID. Obviously there was some very hard hit sectors, restaurants, hotels, travel, entertainment facilities, things like that. But they represent actually a relatively small part of the economy. The massive part of the economy actually, by and large, kept on functioning, and kept on keeping workers employed, which in fact was the most important thing. And so I think that lesson from the pandemic, I think, is really going to be front and center for a lot of policymakers when they think about another round of stimulus. I think there's probably a perception out there that we overstimulated relative to the need. It was hard to tell in March of 2020, and certainly I think policymakers did a lot of really, really smart things at that point. But in later rounds of stimulus, I think there's now probably, with some hindsight, a reflection that maybe the stimulus wasn't necessary. And you can certainly see that with a lot of the excess cash that's sitting out there now. So I don't really see it as likely now, and I think. Unless things get dramatically worse, which I certainly hope they don't, then I think you're going to see this continuation of this trend that we're on right now.
Yeah, I agree wholeheartedly. I think that keyword adaptability of these companies to sort of shift a lot of their business models or pivot to a work from home dynamic kind of accelerated that technological advance and that sort of culture shift with a lot of workplaces, which was very fascinating in my opinion to see. You did mention the monetary policy as well. That's something that a lot of Canadians have their eyes peeled to, is the Bank of Canada rising interest rates. We saw an interest rate hike just recently. And I guess the overall trend is to expect more hikes coming up. And then I guess what would be your message or your thoughts on those anticipated rates that are coming up?
Sure. Well, I guess I'm sure most of your audience knows the implied forecast, so that the market is assuming 6 more 25 basis point rate hikes over the next 12 months or so, and with Fed funds peaking around 2.5 in the second half of 2023. Personally, I think given the strength of inflation, the likely price increases that are still coming, driven by the Russian invasion of Ukraine and just broader supply chain challenges that were already out there, that forecast seems pretty likely to me, and is also not surprisingly pretty consistent with some pretty smart forecasters that are out there. So I think that's probably a pretty safe bet in terms of the outlook. The only question that I've really ever heard bantered around a little bit lately is whether or not the Fed is going to be, or the Bank of Canada is going to be a little bit sensitive to the impact on growth rates that obviously come with rate hikes. And my own personal view is I think the answer to that's probably not. We've it's another one of these things that people have kind of forgotten, but the Fed's mandate is financial stability and price stability, not generating GDP growth. And it shifted to GDP growth because we didn't have much of it for so long coming out of the financial crisis. And they had so much room to play with rates to drive growth because inflation wasn't even a topic of conversation. But that's clearly changing. And so I think the central banks are going to go back to their core mandate, which is fighting inflation and keeping financial stability in their economies, and not focus that much on the potential that might have to impact growth rates. So I think it's unless we see something dramatic happen, I do think that's probably a very likely change that we're going to see in rates. I do think the one risk, though, that is sort of floating around out there is stagflation, and we're talking a lot about history already today, but this goes back even farther into history in terms of the last time we saw that kind of an environment where you get that persistent inflation despite high rates, and yet we see GDP declines and increases in unemployment. And that's obviously an even more painful environment economically than even kind of your garden variety recession. And so I think that's probably the bigger risk. There's going to be some painful transition points as we see that rate hike trajectory unfold. But if we end up slipping into a stagflation environment, I think that'll be a completely different paradigm. I'm kind of on the fence on that one, frankly. I think amongst all of those variables that would have to line up for that environment to take place, the one I'm probably maybe a little more bullish on is employment. I think employment is likely to stay strong, mostly because I think the structural shift of production back into domestic economies driven by deglobalization trends is a real thing. And I think that's it started with the former regime in the United States, but it's really going to really be, I think, pushed to the next level because of the supply chain challenges that we're dealing with now, and then the further supply chain challenges that are going to come as a result of Russia's invasion of Ukraine. I think that there's a whole bunch of companies right now that are thinking about remaking their supply chains and focusing as much as they possibly can on domestic production. And so that's going to put a bid underneath the employment levels at least in North America, I think.
Yeah, just how you touch upon that sort of deglobalization and focusing on things domestically. I mean, you hit the nail on the head there. I think also you saw a lot of that too during the pandemic, where pharmaceuticals, for example, Canada as a nation, for example, were very reliant on other our neighbors in the down south to sort of help us rely on a vaccine supply, for example. So it's a very interesting comment that you made there. And speaking on the whole monetary policy shift.
Just before you move on, Wazir, I think the one other element to that too that is going to be very, very, very material is the change in the thinking around domestic production of food. Mm-hmm. The food security is going to be a massive topic over the next decade, as well as energy self-sufficiency. And so those two trends added on top of that deglobalization trend that we talked about is a pretty powerful force for employment.
Yeah, I agree for sure. And that's something that we'll touch upon when we get into the Russia-Ukraine conflict as well. I want to shift things into inflation and housing. I know you talked about inflation and the central bank and the Bank of Canada's mandate around there. I think we've seen it now more than ever. The average Canadian, just how scary inflation can be, and sort of the impact on the day-to-day, lives of an average person in Canadian. And people talk about the gas pumps. We talk about real estate, which is another topic I want to get into. But what does high inflation look like for an average Canadian outside of just gas at the pump? In your opinion?
Well, I guess it depends a little bit on how the wage cycle plays out. And so, in a normal inflationary environment, if you see wages keeping pace with price increases, then hopefully, for the average, clearly the average is going to mask a lot of pain in certain areas, but the average is probably going to be relatively neutral. But a couple of things that are different, I think, this time around versus prior cycles of inflation. And again, we're going back a ways, but the ability for wage, or a lot of the driving force around wage inflation in prior inflationary periods was driven by unions, and unionization has declined dramatically over that time period. So that upward collective pressure on wages is not likely to be the same as maybe it was in prior periods. But I would say on balance, you're probably going to see a general decline in the standard of living across the board, as you would normally see in most times of inflation. Because I don't think wages will keep pace with some of the really material price increases that are going to happen. Not the least of which will be energy and food, and then finally debt service costs. And so when you put those three things together, you're probably talking about the three largest components of the average person's personal expenses. And all three of those are seeing dramatic increases that aren't likely to go away anytime soon. If you think about the impact of Russia and Ukraine on food supply and on energy, that's not something that's going to go away, over the course of probably the balance even of this year, unless something dramatic happens. So I think the average Canadian is likely to feel some pain. I would have expected to see a rally in the Canadian dollar that would help offset some of that in terms of the cost of imports. And that hasn't really happened as much as I would have expected. So that kind of buffeting effect hasn't really happened yet either. So I do think that we're in for a period of relatively difficult financial conditions for the average consumer. And it's, unless something dramatic happens again particularly with global commodities, I don't think you're going to see much relief. I think the other element, though, that maybe is probably less talked about is, these conditions are probably even more painful for corporates. Corporate profit margins are very likely to be squeezed. Higher debt service costs, higher energy costs, higher wage costs for them, higher cost of supply chains, obviously all very negative for corporate profits. The only offset to that is passing through higher prices. And to some extent they can so far because consumers are sitting on so much cash. But when that trend slows, you're going to see corporate profits really start to get squeezed. And so, that means, at least in my view, your equity and your debt holdings are not likely going up a whole lot anytime over the course of the next year.
Yeah. So those are fantastic points. And you touched upon energy and food. I think the other sort of key expense that everyone faces with is housing, right? And I think that's one of the, it's almost a phenomenon, over the course of the pandemic, just how much housing prices have increased. I'm here in Ottawa and also just southern Ontario, you're looking at year over year growth of 20-30% in some areas, which is sort of unprecedented, really. I was reading a statistic, the average home price in Ottawa is roughly $750,000. The median household income's $100,000, and that gap is only increasing as you talk about sort of the wage challenges that we're seeing. What is the impact that you're looking at, and what are your thoughts in general on the recent housing price increases, and how you see sort of the consumer sentiment shifting towards real estate purchases?
I guess I'll admit I'm somewhat confounded by it as well. And I think there's some general trends, which I'll talk about in a second, which are clearly supportive to housing prices. But Canada is almost kind of unique in the world. There's probably a very small handful of countries that look like Canada does in terms of the size of the price increases that we're seeing, certainly relative to household income, as you mentioned. And I think in terms of the question I get a lot is, are you expecting a big housing price decline, or the bubble to burst? And I would say it's probably not likely to burst. I think we're likely to see probably some slow and steady decline, and for a couple of reasons that maybe are not always obvious to people. But the big issue with housing is obviously higher rates and higher mortgage costs. You would think it's pretty simple math that if mortgage costs go up, the same person making the same amount of money can buy less of a house. But what happens, certainly for existing borrowers, payment levels generally stay the same for mortgages, even for variable rate mortgages when mortgage rates go up, because all that happens is more of the payment goes towards interest instead of principal. So people are paying down debt less quickly than they did, but their monthly payments aren't really changing. Now, on refinance, that will obviously change, and so you could expect some pain there. But even then, borrowers can typically extend the remaining amortization period of their mortgages and keep their payments level. So, and then for other consumer loans like car payments and credit cards, those are mainly installment payments anyway, so they're not really impacted by rate changes either. So I think the impact of higher rates on consumer balance sheets is probably actually fairly manageable in the short term. So I think the real issue for housing is going to be, where is the next buyer going to come from that can afford a house, like you said, of $700,000 in Ottawa, when their wages haven't gone up anywhere nearly at that same rate. And so I think it's a couple of things that are happening. First, again, I keep coming back to the same theme, but we overstimulated the average consumer, and so they just have more cash sitting in their pockets right now, and so you'll see larger down payments. So even though rates are higher, they can chin up to a larger down payment and still make the same monthly payments they were making, before the house appreciated as much as it did. Secondly, there's a huge generational wealth transfer that's happening. So the next generation of home buyers is getting an influx of cash in a way that prior generations didn't really get. And so that's causing some of that price inflation. That will probably take a couple of years, maybe more, to actually fully work their way through. And then third, there's, I'm sure as your audience knows, lots of supply challenges on the housing side. They're not building them anywhere near fast enough to keep up with demand. COVID for the last 2 years has really put a damper on supply as well. Obviously, people don't want people coming into their homes during COVID looking at their house. So that the supply in the marketplace has been really, really challenged. And so those are all, I think, transitory things that are likely to go away over the course of the next couple of years. So that's why I think we're not going to get a bubble bursting, because that's going to take a while, I think, for that to play out. But I do think we're going to see a decline over the course of the next 2 to 3, maybe 5 years. And whether the whole 30% increase that we've seen over the course of the last year or so comes back out, I don't know. But I do think probably a fair bit of it does. The only other thing on the flip side of that, though, is there's a couple of positive factors that are driving prices a little bit as well now, or we'll put some stability into that, potentially into that decline. One of which is immigration. Immigration rates slowed quite dramatically during COVID, and the new to Canada segment is actually a pretty important part of the mortgage market every year, and so that's starting to pick back up again, and so that's gonna help soften what otherwise might be a larger decline. Secondly, we've seen a real surge in investor buying of houses. This feels maybe a little bit more bubble-like, but because this ends up getting a bit circular when you hear what I'm saying. But what happens, as I'm sure you know, is people, these aren't sort of investors in the typical sense, but these are homeowners who have seen the value of their home rise and value of all homes rise. And so they're taking money out of their homes and buying a second or third home as an investment. And so that's the percentage of the investor in the average mortgage application that we're seeing these days is much higher than we've seen in the past. And it's typically that phenomenon. People who own a home are buying a second or a third or fourth home as a real estate investment. And that works so long as the wheel keeps spinning. But as soon as prices start to go the other way, obviously there's a lot of pain that could be associated with that. But again, consumer balance sheets are actually in pretty good shape. So there's probably a lot of those investors that can weather a little bit of a storm. So for all of those reasons, I think we're going to see that sort of relatively slow decline in prices. And certainly in some of the sort of second and third tier markets, the big urban centers where all of the jobs are likely to have a reasonable amount of support to them just for that reason alone. But a lot of that crazy inflation we've seen in kind of some of the peripheral areas, as people have moved out of cities because of COVID, people have downsized into smaller places. That trend will slowly start to slow down, and I think when that happens, you'll see a lot of those peripheral markets start to give up a lot of the gains that they've seen over the course of the last little while.
Yeah, we've seen that a lot, obviously, in my line of work. Real estate investing and generally just mortgages come up a lot, and you see a lot of consumers who are leveraging their primary residence as a means to get into the investor real estate market. And what we're seeing now, especially with the rates rising, as you were speaking about earlier, is that with prices going up and rates going up, it's even buying a property as an investment is also starting to become unreasonable or unjustifiable in many cases. So it's very interesting. A lot of conversation I have around is first-time home buyers. They're sort of the ones that are getting a little bit left behind unless they have that generational wealth that you were speaking to as well earlier. I just want to ask briefly, do you see anything in terms of legislation or policy that could help these first-time home buyers get into the market? We have our first-time home buyer benefit plan, but when we talk about 20-30% increase in real estate, is that benefit really going to help them out that much versus some other type of policy changes that could be implemented?
Yeah, I'm probably not. I think there's sort of two things like that could happen on the policy side. One would be more pressure on banks in terms of qualifying rates for mortgages. So something that would come from like a regulator like OSFI. So increasing that 2% additional qualifying rate stress test, which is probably not a bad idea. And particularly as that base rate goes higher, a 2% test when mortgage rates are 2% is one thing. A 2% test if rates are 8% is not quite the same thing. And so that may change a little bit over the course of time. But that side of the regulatory spectrum isn't really responsible for cooling the housing market or encouraging home ownership. They exist to make sure that there's sound decisions being made in the financial system, particularly at banks. The other side of the policy equation would be the government. And they've tried, you would know as well as here, they've tried so many different things over the course of time, not just in Canada, but in the US as well, to encourage, or to support first-time home buyers, and to varying degrees of success. There's really only two things that make a difference in terms of affordability for, on a broad basis, and that's the unemployment rate. And so, demand for houses and mortgages changes almost perfectly correlated with changes in the employment rate. And then the other thing is deductibility of mortgage interest. So I can't see that coming to Canada anytime soon, but if you did see that, then obviously that changes the affordability equation an enormous amount for all buyers, but for that first time buyer as well.
Yeah. No, I think it's going to be interesting the way things play out in the next 12 to 18 or even 24 months on the real estate side and also on the inflation side. Obviously, with those expected rate hikes, we'll see how the market cools off and how inflation gets impacted. But I want to circle now into one of the very topical discussions. Obviously, is Russia's invasion of Ukraine, and obviously it's a very heinous act, and the conflict going out there is devastating. I want to chat about that conflict in general in terms of the global economy. Of course, we haven't seen really a threat like this in terms of a global conflict and potential escalation, since previous world wars and things along those lines. What were your high level sort of immediate reactions to the global economic implications of the invasion of Russia of Ukraine?
Well, I guess we've talked about it a lot already, but the obvious one is how inflationary that is and will continue to be, and particularly on the big commodities that Russia and Ukraine export. And energy, we've seen that dramatically. We'll continue to see that in wheat and many other types of food exports. But then the thing that probably concerned me the most was some of the other moves that we saw that were just kind of really sort of chaotic, like what was happening with nickel prices, say, for instance, and those kinds of crazy distortions that were happening in short periods of time. Those are the kinds of events at least in my experience that I've seen, that then trigger some other event somewhere else because somebody is on the wrong side of that crazy move, and they get completely blown up. And so, the first thought was, what that means for European banks that have exposure to the Russian economy, or that have actually physical presence or a lot of lending in Russia, lending to Russian corporates, all of that component of their portfolio is going to be significantly challenged. And so I'm sure most financial institutions in the world were doing immediate scrubbing on how much exposure do you have, first of all, directly into Russia. For most North American banks, or at least most Canadian banks, very limited, because that's just not our business model. Secondly, but more importantly, do you have exposure to someone else who has themselves exposure into Russia? And the financial system is so interconnected now that it only takes one of those pieces of that chain to experience a severe amount of stress, and then the world changes dramatically. And the biggest concern for me as a CRO is usually typically liquidity. And so when you see stress events like this, the impact on the global economy is that liquidity dries up. Everybody takes effectively, to use it's a kind of a cliche, but everybody effectively takes their money and puts it under the mattress. And so all of that money that's lent out in the system every single day that supports all kinds of activity and financing and asset values, all of that starts to dry up. Particularly any kind of lending for any kind of a term. Companies or financial institutions that typically lend for 1 year, 2 year, 3 year, 5 year, like BMO in the form of loans, start to think, well, I'd like to see how this plays out first. So I'll lend money for overnight or for a month or 2 months, because then I'm pretty sure I'm going to get my money back. Lending it out for a year, 2, 3, or 4 starts to get very risky. And so the dynamic in the market around liquidity starts to change absolutely dramatically. And like I've said at the very beginning, there's so much leverage in the system that's dependent on those liquidity conditions of the overall financial system, that when you start to change that in a short period of time, really bad things start to happen, and you get kind of 2008 type events that could get triggered if you're not careful. Now, I think fortunately, the way that this has unfolded, it's slow enough and it's understandable enough. So while very painful and extremely heinous, as you suggested, it's understandable and digestible in a period of time that hopefully there's enough of a cushion for adjustment. But in the early days, there was a whole bunch of things moving around so fast and swinging so wildly that there was real concern that there was going to be a big event of some kind that would change liquidity conditions quite dramatically. And so that was kind of the first level thought that went through my mind. Other than just shock that they would go ahead with it, it just it seems so counterintuitive. I guess to somebody from Canada, it's that would just be the farthest thing from my mind that another country would do that. So I guess, and then the second thing that quickly then crossed my mind, particularly as sanctions started to get rolled out, was that this had the potential, at least, to really remake the global competitive landscape in favor of China. And the reason I would say that is because, those sanctions that got put in place were quite severe, obviously really broad ranging, and in some very, very important commodities like energy, like food, like metals and raw materials that are the foundation of so many other products, that if you divert all of those resources to China at discounted prices, because they are effectively the only large buyer of size, that gives them an enormous competitive advantage. Particularly when you put that on top of, the average labor advantage that they already have. That gives them has the potential to completely shift the competitive landscape in the world for, the next 10, 20 years, dramatically in their favor. Now, of course, that would require them to effectively undermine North American and European sanctions, but the two regimes are different, and they don't always see eye to eye on everything. And and that was obvious when the U.S. sanctioned Iran. China didn't have the same view, and that created some of those exact effects that I just talked about. So that was the other thought I had, was that this has the potential to dramatically remake that competitive landscape between the two nations. And so it doesn't look like it's playing out that way, fortunately, but I think it remains to be seen, where those commodities ultimately go, because they will be coming to to somebody in size at dramatically lower prices, irritating the rest of the world, potentially triggering another escalation of some sort. But if it doesn't, that country enjoys a pretty significant competitive advantage.
It's interesting. Obviously, a lot to go through and unpack there. And it's funny, the one comment you made about nickel skyrocketing. It almost immediately made me think about the price of oil in 2021 at one point, where it dipped into negative one day, and just the juxtaposition now to where oil has gone since then. Global commodity prices have just been all over the place and very volatile. One thing you touched upon the agriculture side is the price of wheat. Obviously, for those of you who don't know, Russia, Ukraine, that border is one of the largest global producers of wheat. And presently now is sort of the typical season when you'll be seeing a lot of, wheat farming and agriculture going out. And obviously with the conflict going on, there's a lot of sort of speculation as to where those prices might go. Obviously, the focus now has been oil and gas. Where do you see those agriculture prices, particularly wheat, kind of going, considering that these events presently?
Well, I think unless sanctions are lifted, wheat isn't going anywhere. Well, certainly unlikely to go down anytime soon. The combination of Russia and Ukraine in terms of wheat exports are the same size as Canada and the United States put together. And those are the next two, or those are, after Russia, the two largest producers of wheat in the world are Canada and the US. And Russia and Ukraine actually add up to slightly more than both of those countries together. So when you take that amount of supply out of the market, some of it will find its way indirectly for sure around sanctions. But when you take that much supply out of the market, it's there's just no chance that those prices can go lower. I think on energy, I would probably say the same thing. There's, I guess it depends on whether you're talking about oil or gas now, because gas there's I'm sure the audience knows that the unique situation in Europe where they get the majority of their gas from Russia. So, you get into some pretty severe hardship when you start to restrict Russian gas exports. But if they do go to that step, which is altogether possible, you're going to start to you're going to continue to see an escalation in those prices. So, there's probably going to be a slow decline over the course of time as alternative supply comes online. And I think fortunately there's enough alternative supply, generally speaking, out there. Some of it's still on the ground. Some of it, it needs to be, we'll have to go through refining and distribution, but eventually you can start to offset some of that supply, but it takes a long time. Like they're just too big of a producer for it to have any other impact other than up and staying up for quite a long period of time. You won't see those crazy moves like you saw in nickel, and I don't expect, you're going to see oil go to $200 or something like that, other than some crazy phenomena that might take place, like when it went negative. But, that's just something technical or very weird is happening. That's very isolated in some pocket where somebody is scrambling to cover an exposure. But by and large, I think you'll start to see those prices they'll probably likely stabilize at these levels and then slowly start to come down over time as alternative supply comes on board. But it's going to be a very painful transition period, very painful.
Yeah. And you touched upon the sanctions. Obviously, these are unprecedented sanctions that have been placed on Russia, and you see the reports in terms of the price of the ruble just free falling, unemployment skyrocketing, all these, not only just from a global perspective of countries not doing business there, but you've seen a lot of corporations pulling out as well. I just want to get your sort of thoughts on, obviously it's devastating for the Russian economy, but in terms of these unprecedented sanctions, what type of long-lasting impacts do you anticipate on the Russian economy? Is this something that you think might be in place for obviously an extended period of time, or it could be further escalated? I just want to get your thoughts on that. Sure.
Well, I guess it's going to depend on a few factors. First of all, I feel terrible for the average Russian. I'm sure there's lots of Russians that don't support the war and yet are going to be very badly impacted by it. And unfortunately, are victims of a regime that has made decisions on their behalf that they likely don't agree with, but are paying the price for. So I guess number one would be unless there's a regime change, I don't anticipate the situation changing anytime soon. With that said, we've seen other situations like this, maybe not, with a military conflict, but, where there's been severe economic devastation in a country, including sovereign defaults, but where you have subsequent regime change and fiscal policy change that takes place. Global investors and global corporations eventually start to come back. And so I don't think it's a forever kind of a thing, but I think for so long as that regime is in place in Russia, it will be very likely, it'll be extremely difficult reputationally for any company, any Western company, Western Europe or Western Hemisphere country to be active in Russia from a reputational standpoint. And then even secondarily, I think it's really difficult for you to, do the calculus on the risk of operation in a country like that when that type of a regime is in place. So until you get regime change, I don't think you'll see any change in the economic trajectory of the country, and it's likely to be very depressed for an extended period of time to the extent that that regime doesn't change. So I think that's I guess my short answer to the question. Hopefully that'll happen, and like I said, over the longer term, I think the markets tend to have a bit of a shorter memory about these kinds of things, and so I think as long as you get some new leadership in place there, then the prospects could come back to hopefully even where they were before the invasion.
Yeah, I want to touch about one last point here on this discussion, is that we kind of discussed earlier about deglobalization and sort of the ability to be self-sufficient in some categories. You touched upon how much of Europe is reliant on that Russian oil and gas. Obviously in Canada here, we're one of the largest global producers, but still seeing some of those impacts on the gas side and commodity side. Do you anticipate a larger shift to whether it's on the renewable side, for example? Do you figure a lot of these countries are going to start, accelerating their mindset in terms of energy self-sufficiency or escalating their renewable policies in those areas, just given the impact that this conflict has had on the commodity side?
Yeah, I think absolutely. I guess maybe the other thing to my prior answer in it depends category would be, I guess it depends on how long sanctions last. And, that's I guess a question of how much political will there is. And, to continue to bear the pain domestically that's going to cause on the countries that are doing the sanctioning, that are paying higher prices and things like that. But it feels like there's a lot of support for sanctions and a lot of anger directed at Russia. So it feels like it's going to last for a while. And so for as long as it does, in that period of time, there's going to be this enormous transition of supply chain to kind of the new global economic pacts that are getting formed. And one of the things that's happened as a result of the invasion is that the partnership between North America and Europe has gotten way tighter than it ever would have in normal course. And so I think you'll see a lot of the trade activity between North America and Europe increase dramatically. Now that has price implications as well, because distribution costs are different. But and then you'll see the same thing. You're seeing the same thing happening right now in the Asia Pacific region, partly to reduce the global dependence on China. And so I think that is going to start to redraw a lot of how the supply demand is moving around the world. And I think energy for sure will be a big part of that. I think renewables, this will light a fire under renewables if there wasn't already, and I think there was an enormous amount of momentum there already. This has now catapulted that momentum into the stratosphere. And Europe was already leading the world in terms of momentum in terms of renewables. And I think this will now probably bring the rest of the world more in line. It'll be an interesting period, right? Because at the same time, energy companies that produce fossil fuels are making enormous amounts of money. And so one of the trends that had been happening that was driving renewables was there was just a complete dearth of capital going into the fossil fuel energy sector. So that was curtailing everything, certainly any new exploration, but even starting to make some regions, uneconomic or unfinanceable, that's likely to shift a little bit. And so on the one hand, there's going to be a definite amount of demand or definite demand for renewable solutions. On the other hand, there's going to be a lot of money made in fossil fuels in the next little while. That's going to divert a bit of capital to that segment as well. But hopefully, if regulators and policymakers and governments are smart about this, they'll keep the pressure on those energy companies to actually use a lot of this incremental financial capacity that they have to develop their own transition pathways to lower carbon production as well. Mm-hmm. So I do think that as long as we do the right things and we don't get too enamored with a lot of the, some of the money that's going to get made in the short term, and we stay the course, this is going to be a huge boost in momentum for the renewable sector.
Yeah, I agree wholeheartedly. I think it's going to be very interesting the way things play out, given this ongoing conflict. We're getting into the last quarter here of this Fireside chat, and I want to shift it to the Q&A section. So, sure. For those of you who have not already put in some questions, please do. There's already a couple that have come in so far over the course of the presentation. So, the first one here I see first question here is, how do you see clean technologies developing and scaling as necessary in Canada in order to meet the emissions reduction goal set at COP26? How is BMO supporting / managing this?
Well, I think I can really only answer that in terms of what the bank is doing and what I think most banks are doing. What policymakers are going to do is I think an open question. I will say, again, this is just my personal view, but this isn't a problem that can get solved by the corporate world alone. There's an enormous amount of transition management that's going to have to take place at the governmental level. There's going to be winners and losers in that transition, and the government is the only one that's in position to help manage that or to provide the right incentives for that to take place. Now, with that said, what I think all banks are doing is, first of all, the big focus right now is on quantifying existing financed emissions. Every bank in Canada, I'm sure in North America, are all in the same boat in terms of scope 1 and scope 2 emissions, very focused on our own carbon footprint and minimizing that to the extent possible. The real big issue, though, is all of what we're financing and the carbon intensity of that. And so that's where all of the focus is right now. And so it starts with, first of all, you have to quantify what you currently have. So if you want to set a target in the future, you have to know where your starting point is. And that's not as straightforward of an exercise as many people might think. The data isn't necessarily as good as you would like it to be in every single sector to be able to quantify what emissions are. You might even find the companies that you're dealing with, that you're financing, won't even agree with your assessment of how much of what their emissions even are, because their data might be different than yours. So it's an enormous challenge, but we're getting there. We're focusing on sectors. So you can imagine how we're doing it. The priority is on the sectors that we think are the largest emitters, and so we'll start there. It doesn't make a lot of sense to focus on the low emission parts of the spectrum, given the magnitude of the work that has to get done. So so most banks are focusing on energy production, automobiles, probably corporate real estate just to some extent, and then potentially agriculture. And so those are kind of the big emission focuses. First of all, quantifying what your existing profile looks like. And then secondly, working with all of those companies to help create a transition plan that gets them to the target. Really, I think this is, again, my own personal view. It doesn't make any sense. I don't think it's going to be successful for us as an economy to say, well, if XYZ company doesn't commit or get to their target, we'll just stop lending them money and they'll go out of business. And so therefore that's enough of an incentive. That stick always exists. And don't get me wrong, we'll use it if we need to. But our primary path will be working with that company to make sure that we're providing them with the right incentives, the right advice, the right guidance, and the right amount of pressure, frankly, for them to have a credible pathway to get to the emissions target that we need them to get to, and that they need to get to support the Canadian net zero ambition. And so that's really our approach, is understanding the baseline, work with those companies to understand the transition pathway, make sure it's credible, help them get there. And then as we do new originations and new financings, evaluate the new financings that we do, not just in the traditional way of, is this a creditworthy borrower, but, is this a borrower that's got, a low enough emissions profile currently, or if they don't, do they have a credible transition pathway? And then once we get kind of those 4 sectors nailed down, then you can start to expand it out to other sectors as well. And so that's really how we're doing it, is by working with every single company that we lend money to, and sooner or later, every single even personal borrower that we lend money to make sure that if we're financing some activity, that activity we clearly understand how that impacts the transition to a lower carbon economy.
No, that's fantastic. That's fantastic. In the sake of time, I'm just going to head right into the next question here. What tips would you have for young Canadians looking to grow into a leadership role such as yourself? What qualities should we focus on in order to set ourselves apart?
That's a tough one. I can only tell you really what worked for me. I honestly don't think there's any secret to success really, or secret to leadership. But the leaders that I respond to the best are ones that have some humility, that have a style that is more empathetic, that is more relatable to people. I found for me, I think one of the key reasons that I've been successful is that, people always laugh when I say this, but is that people they like me. And that seems silly, but when you think about it, what I've always found over the course of my career is, I'm not really a particularly smart guy. And so I need to surround myself with smart people, but that's not enough either. You need to then have those smart people want to work with you or want to support you being successful. And when you're not a nice person, when you're not empathetic, when you're not humble, when you hog the credit, when you're not fun to be around, people don't want to work with you. And certainly if you're an entrepreneur or you're running your own tech company in your garage, then awesome, you can be whatever you want to be. But when you're working in a large company like a bank, you need those people. You need those networks of people that want to be around you, that like you, that want to work for you, that want to see you succeed. I've seen so many people in business where they're not nice people, but they're successful, but people are almost rooting for them to fail. And people don't want to work for them. The good people want to move out of those groups. And so I've always been on the other, tried to be on the other side of that and just be nice to people, treat people fairly, treat people the way I'd like to be treated. Don't take yourself too seriously. We're not like, depends again on what you're doing, but in the banking world, we're not saving lives. Like we're not curing cancer. We're just normal people like everybody else. And so, a little bit of humility with people, poke a little bit of fun at yourself every once in a while. And then, there's no shortcut around working hard either. That's probably the only other thing that I did right in my career was, not every single day, 24/7. I always tried to keep some work-life balance, but, there's, when you have to do the work, you have to do the work. You just got to buckle down and get it done.
Mm-hmm. Okay, I think we have probably have time for 2 more questions here, so maybe we can kick them off in rapid succession. Next one would be, how do you think the Canadian market is poised versus other major markets over the next 10 years? Are you seeing meaningful tailwinds that could lead to significant growth of GDP?
I guess the short answer is, I think it's probably marginally relatively advantaged. Mostly because we're such a large domestic producer of raw materials, and the price differential between a net exporter and a net importer for raw materials is probably going to be the differentiator, at least over the next 5 years or so, just given all of the global and macroeconomic conditions that we talked about over the last little while. So, that hasn't always been the case. In fact, it's been the opposite for, the better part of the last 10 or 15 years, but maybe for the next 5 or 10, that has shifted. So the fact that we're big producers of energy, of food, and metals and other raw materials is going to give us a relative advantage. And then, having a relatively highly educated labor force as well. So as that deglobalization happens, bringing a lot of that activity back into Canada, having a relatively strong labor force and strong immigration policies. I think, one of the things that a lot of people don't know is one of the biggest drivers of GDP growth is net immigration. And so, being a multicultural country like Canada with lots of space for new immigrants, I think gives us a relative advantage as well.
Okay, excellent. We have another question here, one that you might enjoy. This is it says, "Hi Pat, hope all's well. Chris Norris here. I used to work with you as a part of the BMO Capital Market Strategy and Business Management team. I have a more casual question. If you could set up a lunch with any 3 current businesses or finance leaders across the globe, who would you like to have lunch with, and perhaps some insights into your interests? Appreciate it all."
Sure. Well, first of all, hi Chris, how you doing? I certainly remember working with you, and hope you're doing well. I guess I would like to have lunch with Jamie Dimon, mostly because I'd like to know if it's really any different running one of the largest financial institutions in the world, or it's kind of the same as, being at BMO. And whether there's really, because I think being on the looking up at a company like JP Morgan in the same industry as we are, you always assume that life is easier when you have this massive scale and you're operating in this kind of different playing field than everybody else. So I would love to find out from him whether his day is kind of really any different than Darryl White's day or my day. So I think that would be fascinating. I guess I would like to have lunch with one of the leaders from the Tea Party to try and understand the political perspective of the right. I'm not left-wing either. I'm kind of pretty centrist in my political views. I think I kind of understand the leftist view. I don't quite understand the more hard right view. That's frankly seems like a view that's gaining a lot of traction, both in the United States and in Canada. So I think I'd like to educate myself a little bit better in terms of what, outside of, the news version of it, which is skewed for entertainment value. I'd like to have an intelligent person-to-person conversation with somebody that really represents the viewpoint of that constituency, because I don't really think I understand it. I only know what I see in the news. And then I guess I'd like to have lunch with Dave Grohl. I'm the musician. He's a guy that I've always sort of thought if I could somehow be a rock star, I would like to be like that, where he's just a fun, regular guy, super successful. And because I'd like to know if he's really like that. I think he is, but I'd like to know that you can be successful in almost any sphere, including something like rock music, by being that kind of guy, because I think that's how I kind of see myself.
Excellent. Well, it sounds like an interesting lunch, the 4 of you. So
yeah, it's fascinating.
Well, all right, Pat. Well, I think we're coming up to an end here. So first, I just want to appreciate you taking the time for this event. I know you're a very busy man, and I appreciate it, and all the guests here appreciate it. YCIF appreciates it. Thank you all for attending. Thank you all for your questions. There will be a posting of this Fireside chat posted as well for your viewing pleasure. So thank you again, Pat, for joining us, and take care.
Thanks for having me, and all the best to your audience. Have a great week. See you.
Thank you all.